Good afternoon and welcome to the New Frontier Quarterly Update. I'm Cindy Miller, Director of Marketing. Before we get started, just a few housekeeping items. This is going to be an active webinar and we already know there are some burning questions out there. We received a record number of questions during the registration, and during the updates today, there should invite some more. You can post your questions using the QA feature at the bottom of the screen. We will be monitoring those throughout the program. We have built in extra time to address the questions, as many as possible in the program today. And speaking of questions, we have a few for you. So please watch for polling questions during the program, and we will share the results of these polls right away so you can see what others are thinking. We would also appreciate you taking a very brief survey at the end. Thanks for allowing me to run through these things. Now I will introduce our speakers for today. New Frontier's Chief Investment Officer, Robert Michaud, and Research Analyst, Joy Zhang. Over to you, Robert.
Thanks, Cindy. So this is a new format for us. We're really excited about it. I got to write the commentary this quarter, and so we'll obviously be talking a lot about that. Just thanks everyone for being here. So I want to get you right started in. We're going to really talk about three things. So first, Joy is going to talk about the portfolio, what has happened to it, and what's driven the performance in the last quarter. Then I'll be talking about the rest of the world in the last quarter and what some of the important events have been. But then importantly, I think we're going to shift towards thinking about the future. So we're not going to be speculating about the future, but I'll be trying to provide investment insights into what we can think about markets going forward, given the current economic conditions. You know us, we don't make predictions about the future, but we do put a lot of effort into trying to understand things. And so then finally, we'll get to ask questions. Joy and I love questions, so please go ahead and submit them. And here's Joy.
Thanks, Robert. And hi, everyone. I'm Joy. Very nice to see you virtually. And today, I'm very excited to give you an update of Q3 performance. And I would like to start by giving you an outline of market performance. 2020 is a very special year in a lot of different aspects. As we're on the way to coming out of pandemic, we see a lot of zigzags along the way. So what I'm showing you here is S&P 500 index. From the chart, we can see we've had a very good first and second quarters as S&P hit record highs 54 times this year before trending down in early September. New highs are shown in red dots here. And because markets already priced in good news coming from vaccinations and reopening, what we have seen during the quarter is that markets reset expectation with all news start to unfold, from tapering, from sticky inflation, from global supply chain disruptions to concerns over China's economic growth. So with all of these factored in, S&P 500 ended the quarter with a 0.6% gain against a backdrop of still strong year-to-date performance of more than 15%. And looking at other regions and sectors that we're investing across our portfolios, we can see that pressure was being felt by international markets as well. Global ex-US equities were down 3%, and among which Pacific markets were the only region, the major region outside US that ended the quarter positively. European markets were down roughly 1%, emerging markets were down more than 7%, and China was the biggest detractor. If we take China out of EM, we can see that other EM countries were down roughly 2% this quarter. So the big picture here is that we've got strong year-to-date positive performance for equities, well, except for gold and China. But Q3 was a challenging quarter for overall equities investing, and especially for risky equities. As you can see, small caps underperformed large cap, and the equities that ended positively tend to be more conservative or less risky, like large cap growth, low vol, high dividends, and REITs. And the underlying factors of risk changement or risk sentiment change is yields change. What I'm showing here is US 10-year Treasury nominal yield in blue and the real yield in green. As we can see from the chart, yields first declined in July and increased slightly in August, and rose 27 basis points toward late September when the Fed signaled that it will start tapering in November. So yields went back to where it started the quarter. And on the other hand, real yields are still in negative territory. It went up from -108 at the start of the year, but increased at a slower pace compared to nominal yields because of the higher inflation expectations baked in. And because of the yield reversal, we've got very flat returns from fixed income space. US Ag went up 5 basis points. And US tips and high yield were the best performing bonds for this quarter within our portfolios. We're seeing strong demand for tips as people are looking for protection against sticky inflation. And high yield is another interesting one, with a negative real yield creating a very special environment for risk taking, where people start to reach out to lower credit space to get higher real yields. But at the same time, high yield comes with more default risk and is considered to be more risky than investment grade bonds. But what we have seen during the quarter is that high yield is actually less volatile than treasuries and investment grade corporate bonds. That is because they are less affected or they are less sensitive to yields change. And another thing that's affected by yields change is US dollar. US dollar rose to a 1-year high, up 2% this quarter. And the story behind a stronger dollar is that we've got relatively high yields here in US compared to other countries. And that has been attracting capital inflows this year. And what is more than that is markets increase expectation for more hawkish Fed compared to other central banks, as well as growing concern over global economic growth. And a stronger dollar weighed on international treasuries and emerging bonds. So that is the context for this Q3 performance. And now let's jump to portfolio performance. First, we have New Frontier Global Core portfolios. In the chart, blue bars represent Q3 performance, green bars for year-to-date performance, and darker color represents our portfolio performance after fees are taken out. So the big picture, year-to-date performance remains strong and positive, but Q3 was a challenging quarter for investing. Our portfolios underperformed the benchmark for this quarter, and as you know, behind this, fixed income were largely muted. So it's really about equities that attribute most to the performance. And the underperformance is mostly due to exposure to small caps and emerging country ETFs, such as China and EM. And if we move up risk profiles, we can see that low risk profiles outperform the high risk profiles on both an absolute and a relative basis. And this is what we expect, because we don't simply mix the same stock and same bonds according to the stock bond ratio to build different risk profiles. Instead, we optimize around all asset classes to minimize total portfolio risk for a given level of return along the frontier. And to put that into context, 2080 portfolio, for example, has less risky equities and proportionately, such as US Minvo and Pacific markets that did well this quarter. On the other hand, all equity portfolio has more risky equities proportionately, such as China, EM equities, and small caps that did not do well this quarter. Of course, it get more large cap growth as well, but gains from large cap growth were basically canceled out from losses from those riskier equities. And that's for global core. We see the similar pattern for tech-sensitive portfolio as well. They performed in line with global core in Q3 and year to date. And what makes tech-sensitive special or different is because tax efficient optimization, we've got more tax-favored asset class here. Munis slightly underperformed the bond markets this quarter because yields change, and also because for muni space, performance are flow driven. On the equity side, you might have noticed tax-sensitive all equity portfolio had a similar pre-tax return as the global core portfolio, or global core all equity portfolio. And the reason for that is because tax-sensitive has overweight in growth stocks, where gains from large cap growth were partially offset by losses from small cap growth. And moving on to multi-asset income. So year to date, dividends have had very strong recovery, given they were the most affected segment last year because of lockdown. Think about dividend-heavy industrial sector, such as financial, they benefit from higher interest rates this year. Energy was boosted by higher energy price, and rates benefited from reopening. So year to date, we got strong and positive multi-asset income portfolio performance. And this quarter, they checked benchmark performance roughly. And looking inside portfolios, we overweight in US dividends that helped performance. And among all equities, global infrastructure stocks were the best performing assets in multi-asset income, followed by US high yield and US rates. And what is more important about multi-asset income is that we provide consistent and sustainable yield that meets the investment objective of income-oriented investors. And the yields are roughly at 3 to 3.5% at this moment. And that's roughly twice the yield you will get from US Ag, and also twice the yield from investing in broadly global equities markets. And then it comes to the last part of my section, as we talk about asset class performance and portfolio performance. So what are the asset allocation implication changes? So first of all, we did not rebalance this quarter. And the main reason for that is we got broadly flat returns from fixed income and equities, as we have discussed earlier. And also, we are seeing little asset class dispersion, especially coming from fixed income side, while understanding China stands out. China has had its own unique path this year. So it came out pandemic first in 2020, and we benefit from having China in our portfolios, not only from return perspective, but also from risk management. But this year, we recognize the growing uncertainty associated with China investing because of policy pressure and also the issues around property markets. And accordingly, we adjusted our risk estimates on China so that we have less China allocation in our optimal portfolios. And more importantly, we make sure that conservative portfolios have proportionately less China compared to aggressive portfolios. At the same time, we recognize there is significant exposure, China exposure in EM index or EM ETF in our portfolios, and we pay a close attention to those exposure as well. And actually, China allocation lowers from 40% at the start of this year to now 34% in emerging market index. And another thing we pay close attention to is interest rate movements. We have a very dynamic process to incorporate new market data, including yield curve, interest rates, inflation expectation, and also credit spread, so that we can have a realistic risk return estimation of all asset classes we have in our portfolios. And we actually have been applying a risk adjusted or risk related constraint on duration in our portfolios so that we can manage duration risk, credit risk, and equity risk overall in an optimal way. So all of this is to say that we pay attention to a lot of things happening in our portfolios. And with that, I'm going to pass it over to Robert to give you more insights on markets.
All right, great, Joy. Thank you so much. That was a lot of amazing information there, and I definitely appreciate it, and I think everybody else does too. So that's what happened to the portfolio. Next, what's going on right now? I want to think about what's the theme of the world right now. So maybe now we can pop up a poll, and then we can let you talk through and give your feelings on what concerns are the top of mind for you in the global economy. And so from my perspective, the theme is that the last year and a half just keeps going and going. So there's obviously the pandemic. I don't want to bore you with all of that. Everybody knows about that. But we also have to think about, are politics ever going to help the country? Is the Fed going to be able to guide us well? And what's going on with China as well? So it looks like a lot of people are interested in inflation, and so am I. That's definitely on the top of the mind. So thanks for that. So here we go. Trends. What trends are going? I'm very much data-driven person, like to make sure that I'm being rational in all circumstances, and so these can help you out. So on the one hand, a trend of 2021 has been the rise of retail trading. There have been a lot of bored people with a lot of extra cash and no place to spend it, and that's not usually a good combination. But that's led to the success not just of Netflix, but also of Reddit and Robinhood, and people thinking about investing as a game. As a professional investor, I don't particularly enjoy people thinking of investing as a game, so I'm not the biggest fan of GameStop and AMC, or non-fungible tokens make me scratch my head. How are they going to $60 million or so? And how can a Pokemon card be worth more than a car? But that's the world that we're living in right now. And I just want to make sure that think about how is this affecting markets. The other thing for this section is I do want to point out that while all these questions on your poll have been around for a while, there are certain new emerging things like the debt ceiling. People are much more concerned about tapering, and then inflation seems like it goes up and down, but obviously it's on our minds today. So the debt ceiling was supposed to be something that people were quite worried about. It had a very active market on Predictit. In case you're not familiar with Predictit, what Predictit is a market where you can bet on almost any outcome, and then the dollar option will be priced to pay off $1. If it happens, then nothing if it doesn't. And so the price of the option very closely follows what the market's expectation of the probability is. So I do always like to look at Predictit if there's some sort of hard to measure thing. Now, they were saying that the debt ceiling contract was for whether it would happen by October 15th, which was supposed to be the do or die date for the Treasury to run out of money. But obviously we saw that this was a non-event, at least for now. So last week, the debt ceiling was raised and to give enough money till December. So the contract obviously said, okay, well, it's fine. But of course, this is just pushing the problem down the road. So next quarter, we may again get to talk about whether the government threatened to hurt the credibility of the U.S. Treasury. So economic stimulus. Economic stimulus is another thing that was supposed to be a big deal. Ever since January, when there was supposed to be unified Democratic support for doing something big. And this is what the big thing was supposed to be, potentially a $3.5 trillion stimulus bill. Now, maybe it's a $1.5 trillion stimulus bill, lowered infrastructure expectations, whatever is happening to taxes will be less than it would have happened. And anyone hoping for really broad support for childcare or other things is likely to be at least somewhat disappointed. Where this comes in is obviously this is affecting us in two ways, in that stimulus positively affects the economy, it affects economic growth. Of course, injecting money into a capitalist economy also has the effect of risking inflation, which is on everybody's mind. So from inflation's perspective, the bad news for some of these economic stimulus packages is good news for inflation, in that it's less likely. The other thing to think about is what's going on in the economy right now. The pandemic productivity bottlenecks, supply chain problems continues. And the world isn't really sure what it's going to look like, and whether it really wants to emerge the way that economists would like us to emerge from this. And there is the question of, is there some complacency going on in terms of economic productivity? Are people just happy with things the way they are? And that could have implications for future economic growth. So the Fed is trying to lead us in a good way through here. I have to admire Powell personally for doing a fairly respectable job at crossing two obviously different administrations. But the thing that I really respect him for, and the Fed for in general, is that they've seemed to learn lessons from the past. As an investor, what you really care about is, are you able to learn? Are you able to adapt? And pay attention to things and move in a positive direction. So the Fed has really done a great job of that. It has, for one thing, realized that the relationship between inflation, economic growth, interest rates, and employment is not the thing that we learned in classical economics. So it has been doing a pretty reasonable job of paying attention to data and trying to manage inflation and the rest of the economy along with it. But what it's done a really great job of is communicating all of that. If you recall the taper tantrum from 2013, Bernanke tried to do something a lot smaller than what just happened, which is say maybe someday, possibly, we might taper, and that caused a huge panic, which had a big impact on asset prices. What the Fed has actually communicated is that it really strongly does plan on beginning the taper. Which, to be specific, means that they'll start reducing asset prices 10, maybe 15 billion a month from their current level of $120 billion of asset purchases every month. So this is expected to start in November, which means it would be done about a year from now. Keep in mind that this doesn't mean that everything magically disappears. It means that, for one thing, they're just reducing the rate of asset purchases. Eventually, they'll stop asset purchases. And then after that, slowly over time, as the bonds retire, as the Treasury pays their bills, the bonds will disappear from the monetary system, and the Fed will just let that happen. So something that's a little more fun is Bitcoin. Everybody likes thinking about Bitcoin. It's cryptocurrencies, and today, especially, the first Bitcoin ETF was actually launched. When I wrote this, I said it maybe would launch. We updated the slides. It's actually launching today. So this is kind of neat. Not the biggest fan of Bitcoin personally, but I do like ETFs. And just to think about what this Bitcoin ETF would mean is it does sort of bringing it back to gold. Institutional investors did not invest in gold very much until an ETF came along. Investors like us would not have invested in something like gold until an ETF came along. The ability to thinking about an ETF all of a sudden turn something physical like gold or totally not physical like Bitcoin into something that you can think of as part of a portfolio. It's liquid, it's transparent, and it's accessible. You can trade it, and you can think of it in a portfolio context. I doubt most Bitcoin investors are really thinking of it in a portfolio context yet, maybe never, but it does make that a possibility. So how would this affect Bitcoin itself? It could create a demand shock. If this Bitcoin ETF is just a futures ETF, not a physical ownership, but if it did, then people would be buying and selling Bitcoin to right along with the ETF, and it would make it much more of a real asset class. It doesn't change anything about the fundamental issues of the valuation of Bitcoin or any of the other cryptocurrency, how it continues to be incredibly volatile, a huge cost in terms of energy use, and actually not a very good medium for transactions. If anyone's ever actually tried to buy or something with a Bitcoin, it takes a while for it to make its way through. So, but and to think about it back from an investor's point of view, think about the amount of Bitcoin out there is less than $1 trillion. That's a lot, but it's still compared to the rest of global asset classes. To put it into perspective, you have about $11 trillion worth of gold right now. Stocks, bonds, and real estate are the big three, and they're more like $100 trillion each. So this is still a really small portion for an average ownership in anyone's individual portfolio, highly volatile, and we'll see what happens there. And definitely not advising anyone to run out and speculate on Bitcoin. Not quite that gambling type of person. So investment insights. Here's the second big part. And we can pop up a new poll. And the feeling is everything overvalued, right? Stocks are overvalued, interest rates are too low, so bonds are overvalued. Everybody's been buying second and third and fourth houses, or well, not everyone, obviously. So, but real estate has this feeling of being overvalued too. So, what should you do with your money? Probably not put it in a zero interest rate bank account. So, let's see what people. Oh wow, cool. Real estate. That is neat. I wasn't expecting that. So thanks, and I'll be happy to talk more about real estate. Anyway, so the big picture: inflation, bonds, stocks. China is a specific one for us to think about. So first, stocks. Stocks. I want to separate it into a few different places. Is when people say stocks have been going up, they really mean about 6 stocks in the US is what everybody is referring to when they talk about surging equity valuations. And the question is never whether Apple or Google is a good company and valuable. Everybody agrees that it is, but the value of Apple and Google can't be infinity. So what is the appropriate value for them from an investment perspective? I use the word value coincidentally there, but value stocks, on the other hand, have not had a good run. So are they, the question of whether they're overvalued is a very different one from the question of growth stocks, so in some of these tech stocks. Of course, there is the question of value investing is, again, not, it was supposed to be one of the most dependable equity premia out there, a way for Fama and French got a Nobel Prize for saying that value is associated with a risk of distress and investors are rewarded for that. And that hasn't been playing out. Other things to think about is the international perspective is quite different from the US. There has been some surge in European and tech stocks around the world, of course, similarly, but just in general, the markets internationally have not had the same surge of asset prices as there has been in the US. And China's been a completely different story, especially lately, with regulation severely impacting its future prices. So it's a challenging market for equity valuations. And then we can think about, then we can, so specifically thinking about the US. This is, I think of this a little bit as US exceptionalism. The US has done extraordinarily well as an equity market. This is something that I've studied, many other people have studied. I was particularly interested in grad school in trying to come up with fundamental laws like physics laws about what's the relationship between economic growth and equity markets. And I saw that the US was really an exception of its ability to turn economic growth into rewarding investors. So the US has clearly been a good market. It has, and there are reasons for that. It has a lot of more transparency, freedom of capital, and information. It's sort of the poster child of a good capitalist economy. And then, of course, an important one is that there's a culture of the role of a firm is to reward its investors. And that is not true everywhere. And so the US has been a great market. Now it's also, everybody knows that, and it's a much more highly valued market. So there is the question of, is the US going to continue to have outperform the rest of the world by as much as it has? And that's very much a question that's on people's minds. On the other end of the spectrum is China. And China is a fantastic economy, as everybody agrees, but a number of things have happened. So there's certainly been trade wars going on, and one effect of the pandemic is with supply chains and bottlenecks. The trade war seems to have gone to the back of people's minds, but what's really on my mind with China is where is it headed as a country and as a capitalist country in particular, and a capitalist country that cares about letting international investors be rewarded for this. And so we're getting a lot of clues from the regulations in China. And what we have seen is, on the one hand, why should you care if the Chinese government is saying teenagers shouldn't be playing video games that much? But it is part of a larger narrative of saying that how companies should behave is the way that the Chinese government says that they should be behaving for the Chinese people, and not just maximizing their own profits doing what companies do here. So that to me reminds me of one of my favorite old studies, which is, what is the relationship between economic growth and market returns? To sort of put a number on what I was talking about earlier, which is over the last 30-ish years, the US economy in terms of GDP has roughly doubled, but markets have done much better than that. On the right-hand side, so the blue line is the stock market, the red line is the growth. So on the right-hand side, China's economy has grown spectacularly, but investors haven't been rewarded for that. So I don't want to say that you shouldn't invest in China, and I don't actually think that one shouldn't invest in China. It's the second largest economy in the world. Everybody knows this. It's a very important part of the global economy, and it has been actually for us, a very large contributor, or a good contributor to overall portfolio returns. But you can't just say, oh, there's growth, I'm going to casually invest in China. You have to really thoughtfully invest in China, and that's important. And that's one of the reasons why I'm including it here, is that it is something that people have to be paying attention to as a important part of their portfolio. Because even if you're not explicitly investing in China, it does affect the rest of the world, and it's almost half of emerging markets, which is a popular asset class. Now, inflation. So inflation was on the top of everyone's minds as an economic concern. Inflation has obviously a big effect on asset prices, but I want to start by putting it into a historical context. So here I have the Atlanta Fed has a nice statistic about not just regular CPI, but sticky CPI. So sticky CPI is our price changes for things that don't change so easily. So we've seen a lot of commodity prices. People were talking about lumber and things early in the pandemic. Now everybody's talking about gas prices, which have spiked to truly incredible levels. And people are worrying about paying their heating bills, or powering power plants in China with energy. How is that going to happen? So those are not sticky prices. Those prices can fluctuate just like stocks and bonds very freely. So the interesting thing in this chart is that sticky prices recently have not moved too much. The thing I'm trying to point out that everybody else in the world hasn't already is that in the 70s, when we're really thinking about being scared about inflation in the US, we look back to the 70s, and then sticky prices really did move along with what everybody thought of as conventional inflation. So what I'm thinking here is that I'm not in the crowd that says, don't worry about it, everything's transitory. Definitely some of these things do have an impact. Prices on wages and food, and when the local restaurants change the price of sandwiches, they're not going to immediately be able to lower those prices again. Those prices tend to stick, for lack of a better word. And you can't tell somebody, oh, sorry, you have to take a price cut because inflation just went down. So there's likely to be a permanent component of inflation, but where the transitory people are still probably right is that the odds of this turning into a 1970s inflationary spiral are low, right? Think about back then, there was a supply shock. The economy had to slow down to these high prices that we had for energy. Now there's the opposite. There's too much people with too much pent up demand and not enough production from the pandemic. So now the economy has to speed up to catch up to where it was. And so that's a big change and a much more optimistic picture. So as far as rates go, what I do want to point out one important thing, which I actually wrote a little blog about, which is that think about the US interest rate environment from a global context, and you'll see that the US rates look high compared to rates around the rest of the world. Interest rates are negative, real interest rates are negative everywhere, as I think Joy pointed out before, but US rates are relatively high. So one of the things that we have seen and continue to see is thinking about an economic or market equilibrium from the perspective of an international investor. They're going to look around and say, the US is the highest yielding treasury market right now. So those bonds are the highest returning bonds. Are they the riskiest? No, actually, they're the least risky bonds right now. So the US bonds are the highest return, lowest risk asset from the perspective of the very unfortunate perspective of somebody who just wants to buy government bonds right now. The US is a great deal. Of course, it's not the only thing that one should have in their portfolio by any stretch, but this, to me, puts it in context of saying, when you're thinking about treasury bills, US treasuries, they're not an obvious no in a portfolio, which then lets you examine their risk characteristics with in relation to other assets. Do they have some sort of ability to continue to hedge dangerous things that might happen in equity markets? The answer continues to be yes. Bring the last time the government was threatening to default on the debt, for instance, people actually bought more treasuries. So this is the type of safety and risk hedging characteristic that treasuries continue to have. The other thing is thinking about it with currencies. What happens when international investors see that US rates are higher? Well, one of two things can happen as they're buying more US treasuries. One thing is that they will bid up the price and down the yield of US treasuries, so it would go as low as other markets. Whether that's possible or not, that's one thing that could happen. The other thing that can happen is that it could lead to an influx of investment in the US, and so you can have currency return, the US dollar will go up. So I think I want to wrap up here and move to questions, because I heard that there's plenty of them. So.
Thank you, Robert and Joy, for those insightful and timely updates. Now we have more to cover in the Q&A, as Robert mentioned. Just as a reminder, your mic will remain muted, but you can continue to post questions in the QA feature. So let's get started. Joy, during registration, Robert asked, gold is well off highs from January 2021. Is gold no longer an inflation hedge predictor, or is inflation not an issue?
Well, yeah, thanks, Cindy, and thanks, Robert, another Robert, for sending questions earlier. Thanks for engagement. So I think to unpack this question, I would like to think what has been driving gold prices year to date. We know gold went down 8% this year, and other factors other than inflation that goes into playing is that we've got negative real yields trending upwards, and we've got stronger dollar. We've got Fed that's going to start tapering, and likely in this November. So all of these factors actually put pressure on gold. And I think what's more important is to think about time frame. Gold isn't necessarily a good hedger in the short term, but in the long term, it works. If the high level of inflation continues in the next 5 or 10 years. And also in terms of the role of gold in our portfolios, we think it's a strategic allocation to provide risk management and diversification benefits because of its low correlation to other asset classes. So it's not only for hedging inflation, it's to hedge uncertainty that comes from every corner of markets. And in terms of inflation, I think Robert and I also both kind of hinted about sticky inflation. And we've got recent rating of 5.4% CPI, and the bigger contribution are coming from wage and shelter, which have which are lagging indicators. So what does it mean? That it could imply even higher prints in the near future. The happy story or happy ending to inflation story is that, supply will eventually catch up. So it will go away, but we know, like, given the current limitation, given the current higher price in everywhere, in shipping cost, in energy price, so it's unlikely to solve. Inflation will be with us for a very short time period.
That sounds good.
Just to finish the question on gold as an investable asset, if you're thinking about the context of right now, where everything is potentially overvalued, not saying that it is, you got to invest in something. Gold is one of those things that tends to do a good job of retaining its value, whatever the future shocks may be that could be affecting other asset prices.
That sounds good. And then, Robert, we have a question from Derek. This is touching on inflation again. So how will inflation impact fixed income investing and the selection process for your more conservative portfolios?
Okay, so yeah, I do love questions about conservative versus aggressive portfolios because our investment process treats them extremely differently. So first off, right, when we're thinking about any types of risk, a conservative portfolio is designed to look over thousands of scenarios and do a good job of protecting wealth across many uncertain futures, as opposed to an aggressive portfolio, which is really thinking about looking over thousands of scenarios and focusing on increasing portfolio return across those. So, so the conservative portfolios are by their nature lower duration, more defensive, and specifically optimized to reduce volatility in an inflationary environment, among other environments. But another thing that's important to keep in mind is that investing defensively for inflation, some people think it's just about buying tips, maybe real estate, maybe gold, things that are really obviously going to be relatively okay in an inflationary environment. That's not the right way to do it. We're always thinking about a whole portfolio. So while those asset classes are going to be particularly effective in an inflationary environment, hopefully, you really matters what's going on with the rest of your portfolio at the same time. And so just having one piece of your portfolio designed to insure against one thing is not as efficient as having your whole portfolio thinking about, for every asset class, what is its sensitivity to inflation, and building the portfolio to be resilient from that perspective. So clearly, all stocks have some sort of inflation hedge or risk management associated with them, because they can raise prices for their customers, or they own assets themselves that will have values that also go up with inflation. So I think that's the key point, to think about the whole inflation. Don't just think about three asset classes as saving you, and make sure that your portfolio is appropriately positioned for other risks as well.
Sounds good. And then in terms of another question that came in from Lester, any concerns about our national budget shortfalls and the growing national debt, including unfunded liabilities?
So Joy, did you want to answer that, or?
Yeah, I can take that.
Okay.
So to think about this question, I would like to think about in the current context of low interest environment. So even though the debt to GDP ratio is very high, more than 100%, but to think of the cost of servicing debt is actually low, given the low interest rates we're having now. So the debt payments or annual interest payments is actually about 1% of GDP. So I think to think of that from that perspective, it helps to clear questions. And I don't know if it's surprising to know that Japanese government has much more debt than us, and the cost of servicing that is even lower in Japan. So it is not only for US, it's for everywhere that has low interest environment.
Yeah, in Japan, as crazy as it may seem, there were people 20, 30 years ago who bought bonds with incredibly low rates. And that's pretty much what happened for the entire life of the bond. The other thing to keep in mind is that economists have had a evolving understanding of the importance of debt. Old school economists thought, by and large, that debt was sometimes necessary to stimulate the economy, but overall a bad thing. I think that has really turned out to be overstated, at least. So while I'm not a big fan of debt myself, I too have sort of come to be slightly more accepting of it over time.
Sounds good. And then another question in regards to debt is from Jennifer. If the US defaults on debt, how would that impact the market? I'll toss that one to you, Robert.
All right. Well, yeah, I did talk about that. So thankfully it didn't happen. We pushed that forward. But we do obviously have glimpses of what almost happened. It came closer to happening 10 years ago, which was this really surprising, but I think it really advanced everyone's understanding of how the economy works, and in particularly how financial markets work, which is the US Treasury is the safest financial asset in the world. And so if the US treasuries are at risk of not being as valuable as they should be, then everything else is at an even greater risk. And so the implication is that as bad as you think it would be for treasuries, everything else would be much worse, which is really, really bad, because it's very obvious to see what happens to the value of a treasury bond when all of a sudden you're not getting paid back for it.
Yep. And then Joy, I'll send this one to you. Susan, how much of a threat and of what kind is China to the US? Given the trading that we do with them and the US government debt they hold, can you shed some light on why New Frontier includes single country ETFs in the portfolios?
Sure. I think Robert, feel free to chime in. So the way I think of China investing is that, sometimes I think of, the job of central banks. The job is really to manage an optimal mix of tackling inflation and still supporting economic growth. And so for us managers, the job is to control the risk in our portfolios while expanding our investment opportunities. So China, as Robert said in his section, is an important allocation in global portfolios. So you can't not be a global investor without China allocation. So with that, we understand there is some limitation in performance in the near term because of policy pressure. But to think of long-term and think of long-term investing, China as a growing economy and a very strong economic dominance in world trade, I think it's going to bring benefits to your portfolio in the longer term, and also in terms of risk management perspective.
Yeah, just to add to that a little bit, I'm less concerned about China's damage to the US and more concerned about, well, can China damage the whole global financial system? You can say you haven't really arrived as a financial superpower until you've brought down the whole global economy. And so far, China hasn't done that. China's been more of a risk if you think about Evergrande or real estate bubbles or or putting too much regulation on teenagers and tech companies, then you think about, well, that's mostly going to affect China right now rather than the global economy. So I'll just keep it. I could keep talking about China for a long time, but.
All right, so we have another question, and I actually think this one probably it gets asked a lot, but Thomas asked, what is the expected of S&P 500 in the fourth quarter?
I feel like, I have talked about S&P hitting new highs 54 times this year so far. Can you believe that? So earlier this year, we were asking, it's high, it's very high already. It's going to go down soon. But so the question we're having now is, can it get higher? And I think a lot of it depends on expectations. whether or not the supply chain disruptions will be solved in the near term, or can that be solved then faster than expected? So I think that's the real question here. And Robert, do you have any views on that?
Sure. Yeah. So I guess this is probably just about our last chance to say anything. So it's always fun to make predictions. And so two things. One is, this is something that people keep asking about. We've studied a lot. Investing near a market high turns out to be a totally fine time to invest. There's no information purely from where the stock price is about the market level is compared to history about what the future brings. And if anything, it's a positive relationship. So that's one thing. The other thing is, I promised not going to make any predictions. So I won't make any predictions. I'll say the same thing I would say every time, which is the market should go up, maybe 8% a year, plus or minus 15 or so percent. So if you put that in quarterly terms, you cut the expected return in 4 and the standard deviation in the square root of 4. So it's up 2%, plus or minus, what did I say, 4%, 5%, 8%. Sorry, there we go. My math is getting bad in my old age. So yeah, sorry.
So here's another question from Thomas. What should be expected in long-term returns compared to a modern portfolio model, which may model portfolios used today?
Sorry, can you say that again?
Yeah, so what should be expected in the long-term returns compared to a modern portfolio model, which may model portfolios used today?
Okay, yeah, so a lot of modern portfolios in that question. But I think the question is trying to get at given some of the things we've said, which are investors are concerned that everything is expensive, what do future returns look like? So, and wise people say pretty reasonable things about this, which is interest rates are low, but they're not negative, which means that there can continue to be returns to fixed income investors. Asset prices are, equities may be highly valued and may have risen a lot in the past, but that doesn't mean they're going to go down necessarily, but you shouldn't expect things to do as well in the future going forward. I brought up US market exceptionalism. So we've been observing the highest returning market personally. So thinking about it from a global perspective, there still will be global growth. Maybe someday all of that economic growth in China will turn into returns for investors, and having a globally diversified portfolio will help preserve this. That is my feeling, is that if you are a long-term investor, you concerned about preserving and growing wealth, a well-diversified portfolio across many different asset classes is truly essential.
That's good. And I think we only have time for probably one more, and we'll probably have to wrap up, but any client review updates, meeting talking points that you can share with us?
Oh gosh, yeah. So just running through some of my favorite topics. There's that people are thinking about, right? I brought up Bitcoin. Bitcoin has uncertain value, enormous energy cost, not a good medium of exchange. A really cool Bitcoin ETF could make it more popular, but it could also uncover flaws in Bitcoin. And now people can have an easy way to short Bitcoin. So that's not necessarily good for people trying to bet on the positive returns in Bitcoin. Inflation. The core CPI of 5.4% is big, coming from wages and shelter, but there are lagging indicators, as is what Joy was saying. And just like I talked last quarter about sandwiches, eventually the economy will come back into some sort of equilibrium. There's a blog on the sandwiches in case you missed the last webinar. And so these things tend to work out. Don't focus on crazy gas prices, focus on the economic equilibrium working itself out. ESG is another thing that's been on a lot of people's minds. Problems with ESG is no one really knows what an environmental or a good company is. The industry is divided on whether ESG, the good ESG companies have positive returns because they're the future, or ESG companies have negative returns because you're avoiding all of these good stocks that are investing in bad things, but they're highly profitable. And then the thing that's also very concerning for investors is clearly a lot of companies are trying to game the system, just like in the .com days, turning their whatever company into whatever company.com would increase share price. Today, turning your company into a positive ESG company increases the share price. And then I'm not sure that we talked about taxes very much, but one thing as we're sort of coming to the end of the year, we're thinking about tax loss harvesting for our investors and making sure that in a changing tax environment, probably the bill's not going to be as big and radical as they wanted to, and taxes won't change that much. But focusing on that, wait till taxes change before you change your portfolio. Wait till if this is a situation where you can know, wait till you do know. Before potentially making a mistake, because probably we would have made a lot of mistakes thinking that the Democrats are going to, tax everything on investments, and most of that definitely is not going to happen.
All right, so I think we have to leave it there. We're getting close to the top of the hour. Thank you all for joining and attending and submitting some great questions today. For the questions we didn't get to, we will follow up with you after the webinar. And don't hesitate to reach out to our wealth management consulting team, Jesse, David, Nick, and Karen. They're happy to assist. And don't forget the brief survey at the end so we can improve the program. Thank you, everyone, for joining.
Thank you.
Thanks, everyone.